So once again, you're welcome. We'll be continuing with the topic that we're considering under financial accounting, which has to do with presentation and preparation and presentation of financial statements. So where we stopped the first clip was at the presentation of a statement of financial position. So we move a step further today. We'll be looking at the format for a statement of comprehensive income, also known as statement of profit or loss, and other comprehensive income. Mm. And like I've said earlier, I decided to bring these into play, and so that number one, you will see what I was saying about the important features that must be on the financial statement. Look at this: year ended 31st December 2019. That is the period. The currency is in naira. Mm. And so for statement of comprehensive income, we have the following items. We have revenue, you less your cost to sell, then you have your gross profit. You less your administrative expenses, distribution cost, and then you had other income, which includes your income investment. Like sometimes you see they will call it investment received or gain on disposal of assets. Another one is dividend received. All of these form part of other income. You add it up, then you less your finance cost, you know, as well as you know other expenses. Then you get what we call profit before tax. Then you less your income tax, and you have profit for the year. It's very simple the way I'm mentioning it, but understand that there are adjustments to a lot of these items that I've mentioned. After this very clip now, or before we move further, though, I will try to break down some of these items into the adjustment mechanisms. Adjustments that will come under each. For instance, under revenue, they may not give you revenue directly. They may give you sales that was made within the period, and then they will tell you that is what we call carriage. Return inward. Return inward. You understand? When you say anything like return inward, you understand that you have to less it from your sales. Return inward simply means part of the goods that you sold was returned back to you. So meaning that if it's returned back to you, you have to refund money back to the person that buys. So that means automatically that sales on that product was not made. For example, you are selling shampoo, whatever. I wouldn't know what they call that. You said you sold 20, and then somebody now return two. That the two you want to change it to another product that he does not want your product again. I want to go and buy from that person. So that two that they return is known as return inward. You have to less it from the total sale that was made. So when you less it, you have what we call the net sales or the net revenue. Also, under your cost of sales, they may not give you cost of sales directly. They may give you opening inventory, closing inventory, purchases for the period. And then you also have what we call carriage inward. Carriage inward, that is, um, you bought your stock. That's when you made purchases of your stock. Now you are going to spend certain amount of money to bring those stock into the location where you are going to use it. So that amount that you are spending bringing that item in is known as a carriage inward. So you also add it to your cost of sales. So you add it to purchases, and then when you have your closing stock, you less your closing stock from that. You know that normal adjustment in our financial account. So that is that for that. Then your administrative expenses has to do with all other expenses apart from distribution. All expenses that is related to administration of the entity. So that one will come under admin. So you have electricity, rent and rate, a lot of them. And then you now have a distribution cost. Distribution has to do with the selling and the distribution, every cost or expense that was made for the distribution of all of the items. Like salaries of sales personnel or sales director, they are going to come under distribution cost. Motor vehicle, most of the time motor vehicle depreciation, that like for instance motor vehicle, there's the van that is used, the van that is used for distribution or selling of those products. All those motor vehicles that are used for distribution and selling of the product, all of them, their depreciation most of the time will come under distribution cost. If you are in an exam uh, situation, they will tell you which of those depreciation will come to distribution, which one will be in admin. Some will even go to cost of sales. They will tell you in exact what to do with that. And apart from that, you have what we call the other income or income from investment can still come under other income. That's why I mentioned it at that time. I mentioned other income. So other income can include investment income or investment receipt, income received from investment. That is, for instance, you have a company, you invested in another company, but the number of share that you have in that company is not up to 25%. 25% makes the company an actual company to you. 50% makes it a joint venture, and above 50% makes the company a subsidiary. So if your stake is not up to 25%, but you have investment in such a company, uh, the what is it called, the interest or investment income that is received, you understand, sometimes it can be in the form of a dividend that you receive, you understand me, all of those ones, they are also part of other income. Now also, when you dispose an asset and the disposable value is higher than the carrying amount or the net book value of the asset, you should know that you have gain on disposal. That also you bring it to other income. Also, when you have loss on disposal, you know that you are bringing it other expenses. Other expenses. Is that taken? Please note all of these little adjustments. They are very very important. We probably have what we call provisions. Provisions for bad debt. That is provision for doubtful debt. You understand? Provision for doubtful debt. You have to bring them under the distribution cost. For instance, if you know too well that they're going to pay you back, you make provisions for them, then you put it in your. That's what we mean by provision for doubtful debt. That's what I'm trying to explain. Doubtful debt means that the receivable may not be recoverable. So, if you are doubting that it will not be recoverable, you have to make provisions for it from your profit that you are making for the year. That you must consider under your admin or distribution or anywhere you can put that provisions. And you also have warranty provision. Warranty provision. Also warranty provisions. Sometimes you make warranty for those people that are selling all these electronics or whatever, they give out warranties. Now you need to make provisions. So many of them, they make provisions just in case they bring back the item that they warranted, and then maybe the item is damaged. Of course, they should not be a loss to the business, as it were. But then you need to make provision for it just in case, and they return such items that are under warranty. So that is that for that. And your finance cost, your finance cost has to do with the interest that you are paying uh, on loans that you have collected. that is long-term loans or long-term debts. Also, you have redeemable preference share. What is it called? The interest you pay on those ones too. You can bring them under this very finance cost. Yeah, that's that for that. Then another one, you have other comprehensive income. So that's where you have revaluation surplus from PPE revaluation, and then you have fair value changes in financial assets and at fair value through other comprehensive income. That one too is there. Most of the time, you may not see this financial asset revaluations, but most of the time, what you see is revaluation surplus on PPE. Please take advantage of this and then know it. That is that for that. Second one we'll be looking at is the statement of changes in equity. Statement of changes in equity is also one of the statements that we'll look at. And, like I said, it's always going to carry the period that is covered. Year ended 31st December, then put the date. Then you put your rounding off figure. Apologies, please. Rounding off figure. So most of these items that you're going to bring to zero change are items that are under equity in the statement of financial position. We'll put them as the headings. Once they give you, or once you see a trial balance or an information that all the relative items under equity they are given, you bring them under your statement of changes in equity. So we have share capital, share premium, retained earnings, revaluation reserve. Majorly, we always see this one there. You can have foreign reserve. You can have foreign reserve. You can equally have um, other reserves or general reserves, as it were. So you put every one of them as you are seeing them there. So the first thing first that must come under this one is the balance brought forward. Balance brought forward or balance brought down, as the case may be. So balance uh, brought down. That's the first one. Then the second thing that you do is always going to be under retained earnings if there are changes in accounting policy or prior year adjustment, you know, in a retrospect. I mean, in a prospective adjustment. You make adjustment to retain earnings due to changes in policy or due to changes in your changes in policy or changes in your accounting estimates. You understand me? Or when you discover a material error, once you make adjustment to the retained earning, you bring it here and less it from the retained earning. And after you have made the adjustment, you have what we call the restated balance. That is after you have made the adjustment, you have the restated balance. Then next thing that comes in is the issue of shares, or the share issue within the year. You have bonus issue. The bonus issue will always come under the share premium, because we always believe bonus issue are always from those that are premium shareholders. And then other non-bonus issues, you bring them under the share capital. Bring it under the total. Then if you have profit for the year or retain earning, that's if dividend have been paid or whatever it is. So if you have any one of them in return, you bring it here. Profit for the year, bring it here. Then you now have gain on revaluation, you bring it under gain on revaluation. Then you now have transfer to retain earning, and this one too you bring it here. Mm. And then you now have dividend paid, dividend paid for the period, bring it, and then you have balance as at close of the business or close of the year. So that is that for statement of changes in equity. For statement of cash flow, we may not really work on it in this clip because it has a standard on its own, which is known as IS7. So we'll look at statement of cash flow under IS7. Now likely will be after this very clip, after my illustrations and the likes. This one will look at statement of cash flow. Then the last one is no so account. No so account, like I said earlier, is only buttressing on the IFRS compliance and the laws of the land compliance. So you need to state whatever major model method of presentation or recognizing the items on the face of the financial statement. So it's important for us to state whatever that we have used. That's that for notes to account. So very quickly, let's go to illustrations, and that will be the next clip after this one. Thank you for watching once again. I'm grateful.